Good day, everyone. I'm gonna put on a video. So like I mentioned today in class, I will be recording a video that will be explaining today's discussion further for you to better understand and better assimilate. The principles explained today in class is actually very interesting because when whatever kind of business that you choose to own later in the future could either be a merchandise business kind of setting or a service kind of business setting. We talked about that today in class, and I will also expand that further and give you a proper understanding of the theories that consist of the discussion problems today. So the outline would be that we will look into the problems we'll look at the contents of chapter 6 and then the contents of chapter 7. And from there, we will look into the exercise further. I'll start from scratch and then solve the 4 problems and relate them to the explanation that I will be doing right now. And by the time we get to understanding the problems, we will see that the concept of inventory will be very clear and familiar to each and every one of us, which will give us even more confidence to face future quizzes and to do well in our final exams that is fast approaching. Okay, let me share my screen. Sorry, let me share my screen so that you can see my screen as I explain the concept of the textbook. Okay. So, okay, so let's look at this further and understand the concept. Though I explained it in class, I would like to go over it again for your benefit. Today's class, we're talking about inventories, inventory management in any business setting. And we talked about the types of inventories. We talked about what is an inventory and that. So we'll briefly go over it again. And from there, we will look into the problems. But before we do that, this is chapter 6, and it talks about understanding the business. And as you can see here, it gives a brief explanation of what we call operating cycles. Now, for any company to be successful, like I mentioned today in class, it must complete its operating cycle, not just complete it, but it must complete it efficiently. And what is this operating cycle? The operating cycle is nothing but a series of activities that a company undertake to generate revenue, which ultimately leads to the collection of cash. As you can see from Exhibit 6.1, the operating cycle applies to the 2 types or classifications of companies. Companies could be classified into based on the kind of services they offer. It could be a service company or a merchandising company. A service company is that company that offers a service and expects payment in return for their service. And for instance, in the example that I give today in class, I give an example of the United States Postal Service. I have my letter. I want to send this letter to Texas, for instance. I go to the United States Postal Service and I give them this letter. Please, I needed to take this to Texas for me. And I pay them, let's say $10 for doing that. But that is a service company. It is a service company because they are offering a service to me for a fee. Another good example of a service business, let me just, a very simple and common one, like I also mentioned in class. I could just get a polish and the brush and meet you guys in your class and give me your shoes. Let me polish your shoes so that it looks really bright and nice. And then you give me a fee of $5 only. What I do for you is I give you a service by cleaning your shoes and polishing your shoes, and then you pay me in return. That becomes a service that I've offered you. Okay, and the last example would be having a salon. I have a salon. I invite you to come into my salon and I dress your hair, or I give you a very nice haircut, and you look good, you look confident, you're happy with yourself, and you give me money. It's a service company. It's a service business that I have in that aspect because I offered you a service. But there is this second class of business that we call merchandising companies. These companies, rather than offering service, they buy inventories at lower prices and then resell these inventories so that they resell the inventories at sorry about that. They sell the inventories at a higher price than what they bought so that they can make profit for themselves. So the operating cycles of a service business, as you can see from exhibit 6.1, this is for the service companies, and then this is for the merchandising companies. So a service company will sell a service to the client and collect cash in return as a reward, and use the profits from the profit it makes. It pays for its operating expenses. Remember, going to the United States Postal Service, they have a building, it could, assuming that that building was rented or something, that could be paying rent for that building and that, but they use the profit that they make from their services to pay the operating expenses and that. In the same way, the difference between that and the merchandising company is this. A merchandising company buys inventory, like I mentioned. And what is this word, inventory? We'll come to understand it much more. They buy products. Let's put it that way for now. And then when they buy these products at a cheaper price, they sell it to clients and collect cash from the client and then pay for their operating expenses based on what they're paying. Is that understood? I believe. Now, if you take a look at this clearly, it gives you the definition of a service company. It says a service company is a company that sells services rather than physical goods. That is the definition of a service company. An example is given here, the Planet Fitness. They follow a simple operating cycle. They sell services to the customers, collect cash from them, and use that money to pay for the operating expenses. But let's look at the merchandising company. The merchandising company is a company that sells goods that have been obtained from a supplier. Okay, so they buy from a supplier and then resell. And it is mentioned here that merchandising company the products that the merchandising companies buy is called the inventory. So the inventories are sold to customers, which lead to collecting cash that can be used to pay operating expenses and even buy more inventories. Now let's look at what is the definition of an inventory so that we do not confuse ourselves. An inventory is not a building or any other thing, but rather it's those goods that are bought and kept for resale in that. For instance, if I walk into Walmart or Target or Stater Bros here and the rest, if I walk into there, I see lots of goods and services that I can buy. That is their inventory that they are advertising to you for sale when you walk into Walmart. That is the foodstuffs you see, the bananas, the bicycles, the televisions, the supplies, and the toiletries, and that they are all inventories for the company and that. So that is the definition of an inventory, and I hope this is clear. There is still another term that I want you all to understand, which is this term here called the retailers and the wholesalers. When you walk into Walmart and you go into Walmart, of course, certainly, there was a student I asked today in class, and I said, when you walk into Walmart, what do you really love to buy most? And he was like, yeah, he said the Gatorade, right? Yeah, that he loved to buy that. And that becomes, there's a process that product, that particular drink is made of. It is made from a manufacturer somewhere. They manufacture it, they have their plants, they have their facilities, they have their inventories. You need water supply, you need the chemicals that you mix together to form those the drink itself. You need plastic bottles for packaging, and all these form your raw materials and working process inventory, like we will mention further. Okay, so the manufacturer manufactures his products and then sells them in bulk to a wholesaler, and then the wholesaler sells to the retailer. Usually Walmart, they're being supplied, their inventories are being supplied by wholesalers, so they don't deal directly with the manufacturer, though nothing stops them from doing that. Well, that is a normal chain of business. So it goes from the manufacturer to a wholesaler, who buys them in bulk at a cheaper price, and then the wholesaler takes to the retailer. Okay, that is what happens in that context. And the retailer, the customers, which is the client, like you and me, walk into the retail store like Walmart, Stater Bros, Costco, and the rest, and then buy from the retailer. So that is a simple chain of business that I want you guys to understand as well. Okay, so let's move forward in the video. The operating cycle differences in Exhibit 6.1 that you can see here, it leads to some important differences on how services and merchandises companies run or report their financial results. And there are three key differences in the income statement and the balance sheet of service companies and merchandising companies. Okay, now the first is, let me give you another good example of a service company. I know most of you register with some gymming centers where you go to gym and use their facilities to warm yourself up and to build the muscles in that. They offer you their facilities for a monthly subscription. That is a service. You're not buying those equipment that you use for your gymming and that. You only go use those facilities and then pay for using them. That is a service company and that. So now there's a difference between, looking at this, it says financial reporting differences for service and merchandising companies. Okay. Now for the service company and for the merchandising company, let's look at example. The example of the service company here is Planet Fitness, and this is the balance sheet for the company. Whereas that of, we also look at the balance sheet for Walmart, which is a merchandising company. Remember, Walmart is a merchandising company because it sells inventory. It buys inventories and then resell to clients. That is why it's a merchandising company. It is also a retailer because it buys from wholesalers who also buy from the manufacturer. Okay. Now, let's get back to this. One basic difference in the balance sheet of service companies and merchandising companies is that the service companies report supplies as a current asset in their balance sheet, whereas merchandising companies report inventories as current assets. I hope this is well noted. Now, this is so because the service companies do not deal with inventories. Rather, they deal with services. But though they may need supply to run the organization. For instance, I give you the example of the USPS, the United States Postal Service. When you go there, of course, they could need pen, they could need some maybe toiletries for their bathrooms and some papers and clips and that to run their business. That is the supply that we're talking about here. They don't have inventories, but they report the supply. But for merchandising company, they do have inventories, and that is recorded on the balance sheet, as you can see here, highlighted in red ink. And when you go to the income statement of a service company, you will see that they record service revenue. It is the kind of revenue that they earn, like me going to the USPS and paying for them to send my documents to Cape Town. The revenue they make from that is a service revenue because they offer me a service and I pay and they make a revenue from that. So it is reported as service revenue. However, when you get to the merchandising companies like Walmart, they record theirs as sales revenue because they sell to you their inventories. And the money that they make from that is the sale. Okay. Another unique difference is that the merchandising company records the cost of goods sold. Okay, the cost of goods sold. Let me see if I can create a blank document that I can use to explain. Okay, so let me bring this here. Now, we talked about the sales revenue. This is a revenue that the company earns. Let's say, let me give you guys like a very small example. Let's use the example that I explained today in class. There were some sets of people somewhere in the desert that didn't have access to water. And I heard about them, and I quickly ran to Walmart. And I bought 10 bottles. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 bottles of water. So this is 10 bottles of water. And I bought them for $1 each. That means I spent total. I spent $10 to buy. Sorry, this is a mistake. I spent $10 to buy 10 bottles of water. So, and then I used an Uber. I paid $2 to and fro to Walmart and to meet my clients, and that back home $2 would be enough to cover that, right? So I paid $2 to Uber when I was going to Walmart, and also to when I was going to supply to my clients in the desert. Now, there is what we call the cost of goods sold, COGS. It is nothing but the cost of the goods that I want to sell right now, which is the cost of the water bottles that I'll be selling in the desert to those people. And then the cost in this case becomes what? The cost. How much did it cost me to buy those goods and to offer it for sale? Is a cost of good. So after I sell it, I need to keep track of the cost of that good to me. I spent what? $10 to buy the 10 water bottles, and then I also spent $2 on transportation. So the cost of goods sold is $12, right? Assuming that I sell each bottle for $3 to the people in the desert, I'll make a profit of, I'll make a sales, okay? I'll make a sales revenue of the selling price. The sales revenue is equal to the selling price times the units sold, which is, in this case, the selling price that I'm selling to them. I'm selling the unit selling price. Let me use the word units, so we don't forget. Units selling price. In this case, the unit means for one. Okay, so what is the unit selling price? It is the selling price for just one, and it is equal to $3. That is what I'm selling to the people in the desert, times 10 bottles, which makes it $30. Okay, that becomes my sales revenue. I now have what? My cost of goods sold to be what? Equal to $12. Remember, we calculated that earlier. Okay. We calculated that here to be $12, right? There's what we call the gross profit. The gross profit is the difference between sales revenue minus the cost of goods sold. In this case, it becomes 30 minus 12, which is that should be 18, right? Whatever it is, yeah, it should be. And dollars, okay? $18. Are we together? I hope we are together. That is exactly the concept that we're talking about here. We will still come back to this, but let's just go into something else. That is what is happening here. In the income statement, the sales revenue, which is, remember, we can see two terms, sales and service. Service is for servicing company, service revenue, and then the sales revenue is for merchandising company. And merchandising companies have what? The cost of goods sold, of which the difference between the sales revenue and the cost of goods sold gives you the gross profit before you can have up maybe other expenses there on and forth. So the next part I want to take you all to is the inventory systems. Okay, maybe before we talk about the inventory systems, let me take you guys to chapter 7. Let us look at the types of inventories and the classifications so that it becomes much more clear. Let's go to chapter 7. So here it talks about the types of inventory. And it explains further the generic term inventory means goods that are available for sale in the normal course of business or are used to produce other goods for sale. Merchandisers. Who are merchandisers? I give you guys example like Walmart, Target, Stater Bros, and that. The merchandise is the inventory that they have there. All those goods and services that you go to buy. Sorry, those goods you go into Walmart to buy is the merchandise. Okay. So the merchandisers, they hold merchandise inventory. And that is what you go into Walmart to buy. Okay. And the merchant, they said this consists of products acquired in a finished condition that is ready for sale without further processing. The goods you go to buy from Walmart, they're already finished. They have processed them from the factories, sent to wholesalers. Wholesalers are distributed to the retailers, which are in this case Walmart, and they're ready for you to go buy and use in your home. So they're finished goods. But manufacturers, you can see here, they often hold three types of inventories, and these are the raw material inventories, such as the plastic, the steel, or fabrics, or even less down to agricultural products like rice, beans, and that. There could be raw materials. And peanuts could be raw materials for the sunflower oil. that we buy from Walmart. They could go get peanuts from the farm and ship it to the manufacturing site, and that peanut becomes a raw material that will be processed, that will be squeezed, and the juice out of it, or the oil rather, will be extracted and processed further to give us sunflower oil or whatever, or the peanut oil. Okay, if we're using sunflower, then we use the sunflower seed in that context. So that is raw material. And then the working process inventory, it includes goods that are in the process of being manufactured. So when you put all those raw materials together and then you processing them, they become the work in process inventory, because you are processing that to get a final good, which is the peanut oil in this case. And then when you are done, the peanut oil becomes the final good, okay? And that is what we call the finished good inventory. I would not want to spend much time on that, but just read through and learn more about it. So let's go back to what we were talking about. In chapter 6, I think we're back here. We were talking about inventory system. Okay. Let me take this away. Okay. So now we're talking about the inventory systems. Let me open that example that I gave to you. There are some key terms that I want us to look at here. Let's use that to explain the inventory system. The inventory system. The beginning inventory, we have the purchase. This is represented as P. Okay, so this is represented as the beginning inventory. This is purchase. Then we have cost, or let's say goods available for sale. Goods available for sale. And we have what? The cost of, which I've already explained, goods sold, which is the cost of the goods that we sell. How much did it cost us to sell those goods? And lastly, we have the ending EI. Okay. I want us to understand these terms, because when we understand these terms, then we'll be able to understand efficiently today's problems. But if we do not understand them, then we will not be able to understand today's problem. Now, let's say I gave a small example today in class. And the example that I gave in class is that, let's say I have like a mobile truck that I sell pizza. Or maybe let me use another item. Let me just say I sell sandwiches. Now, let me just say, I sell I sell um I sell I think Gatorade, for instance. Yeah, I sell Gatorade, and on my mobile truck, I sell Gatorade. And I did that from the beginning of January, and I intend to do that for the entire duration of the year. So we're currently in the month of November. Okay, so on the 31st of October, at the close of business, I had 15 bottles of Gatorade. I have 15 bottles of Gatorade. On the close of my business on the 31st of October. Then I came into the 1st of November. Remember, the accounting period will be from 1st of November to the 30th of November. I would analyze the performance of my business for this month. Every month, I analyze it for a monthly accounting period. Are we together? So that means on the 1st of November, automatically I had 15 bottles of Gatorade. That becomes my beginning inventory. BI. Remember, the Gatorade is an inventory. It's an inventory because it's a good that I bought and I also want to resell to you guys. Okay, so that is my beginning inventory of the accounting period. And I see that I think there are lots of students. I still need to increase the amount of Gatorade that I have to do business. And let's say on the 3rd of July, I still have 15 bottles unsold. I have not gone into business yet. On the 3rd of July, but my beginning inventory is 15 bottles already. Then on the 3rd of July, I go to purchase 25 more bottles of Gatorade. Sorry, GA. This becomes my purchase, brackets P, because that is what I went to purchase within the accounting period. So I have what? 15 bottles here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. That is 15 bottles and that is equal to my beginning inventory of Gatorade. And this was what? On the 1st November 2022. Then on the, let's say, 4th of November 2022, I made a what? Purchase of 25 bottles of Gatorade. Then on the 18th of November 2022, I went in. I went out and then I sold Now, but before I do that, please, before I get to the 18th, so remember, I had what? 15 bottles of Gatorade. And let's say these 15 bottles of Gatorade, they were kind of like the smaller, the medium size. So, and the medium size cost, let's say, $4 per bottle. This becomes the unit cost, okay? This is how much it's costing me. So there's a difference between unit cost and unit price. Unit cost is how much one item per unit, just one item. How much is it costing you, the buyer, you know, the buyer who is going to resell. Okay, so it's costing me $4 to buy one bottle of Gatorade. And I bought what? 15 bottles. That means, let me grab. So it becomes 15 times 4. That is $60, right? So okay, so it cost me what? $60. That is 15 bottles times $4 per bottle. You know, to give me what? $60. Sorry, 15 bottles, right? 15 bottles of Gatorade multiplied by $4 per bottle will give me $60. That is how much the beginning inventory costed me in this case. That is how much the beginning inventory costed me. But this set of 25 that I bought on, sorry, I'm recording this on the wrong place. Control. Okay, so yeah, let's bring it here. Okay, the 25 bottles of Gatorade that I purchased that. I purchased the 25 bottles of Gatorade at a slightly different unit cost price, because this one, they are like big bottles. Okay, so $8 per bottle. And then times 25 bottles, right? Will give me the total amount of cost, 8 times 25, which is $200. That is how much I spent to do the purchase. The purchase becomes P. And the purchase becomes P. Okay. And let's go back to these and understand our terms more. On the 18th, that means I have what? here I have 25 plus 15 bottles. Remember, my beginning inventory was 15 bottles, and then I purchased 25 larger ones. So it becomes what? 25 plus 15, right? So total inventory, total current is equal to what? My beginning inventory plus the purchases. That is the total current that I have, which is equal to what? The 15 bottles plus the 25 bottles that I bought additionally. And this is what we call, well, first of all, it becomes 40 bottles in all. And this is what we call the goods available for sale. So now I have 40 bottles available to sell, which includes 15 bottles of beginning inventories and 25 bottles of purchase on the 4th. That is what I have available to sell to my clients, right? So whenever you have the beginning inventory and you add it to purchase, it gives you the goods available for sale. And now let's go back to the 18th. Let's say on the 18th, I sell on the 18th of November, I sell out of the 40 bottles, I sell, let's say, 10 bottles. I'll be now left with 30. My ending inventory becomes 30 bottles. That is my ending inventory. Now we will be able to use what we call anyway, let me not move too fast. We'll still come back to this. Let's just go. We'll still come back. This will bring us to the concept of FIFO and LIFO. FIFO means first in, first out. Then LIFO means last in, first out. We will still come back to that. So there are two kinds of, I'm taking too much time. So I just need to go faster and summarize everything, and then we look at the problems quickly, and I call it a day. That is the beginning inventory that I explained to you. The goods that is available at the start of the accounting period, you know, and during the accounting period, the cost of new inventory is called the purchases. And we can see that the beginning inventory plus the purchase gives you the goods available for sale, like I mentioned. And the goods available for sale, if you sell them, it gives you what? The cost of, there's a cost that is going to come on you for selling those goods, some portion of it or even all of them. And then the remaining, if there are still some balance, we call that the ending inventory, EI. Okay, so this is the cost of goods sold equation. We can see that the beginning balance plus the purchase minus the ending inventory is equal to the cost of goods sold. So there are two kinds of inventory system. We have the perpetual and we have the periodic. You can see them here. The periodic or the perpetual inventory system. In the periodic inventory system, the company just does business and do business and do business, and by the time it's in the end of the period, let's say at the end of the month, then they count all the inventories that they have remaining, and from there they will be able to know their cost of goods sold. So this equation is for the periodic inventory system. However, the perpetual inventory system is the system used by Walmart, where you have like a POS scanner, point of sale scanner, that scans every item that is going out and coming in, and scans the real, it calculates the sales revenue and that, you know. So it gets the cost of goods sold and automatically gives you the ending inventory. So it's kind of like a more efficient system. And that is that. Take note of these two equations. They are very important to the problems that we'll be solving. So you can read more about the periodic inventory system and the perpetual inventory system here. A periodic inventory system updates the inventory record for merchandise purchase, sales, and return only at the end of the accounting period. It has a problem because it cannot detect missing inventories that could arise maybe due to fraud, due to theft, or due to maybe miscalculations or errors. And however, the perpetual inventory system updates inventory record every time an item is bought, every time an item is bought, sold, or returned. And you may not realize it, you know, for instance, the blah, blah, blah. But looking at the inventory control, another benefit of perpetual inventory system is that it allows managers to estimate shrinkage. What is shrinkage? The shrinkage is the cost of inventory lost to theft, fraud, and error. Let's say, you know, as Walmart is there are customers that come in and steal their inventories, their items without paying. Also, they also have workers there that steal from the company, and also there could be some times that maybe some of their workers do not intend to steal, but they may do mistakes and then record inappropriately some inventories, and then those ones they are not accounted for anymore, or there may be some fraudulent activities thereabout, and those inventories will disappear from Walmart and serve as a loss to the company. So that is the shrinkage we're talking about. So without taking much of your time, let me quickly go and talk about the LIFO and the FIFO. And then we solve the problems and we're done. We're almost done. Let me go to chapter 7. Okay, when you look at this part, you'll see the inventory costing methods. That is when we talk about the LIFO and then the FIFO. So you can see the first in, the first out assumes that the inventory costs flow out of the order in the order that the goods are received. Okay, let's see for this first in, first out. On May 3rd, I bought some inventory at this cost. It cost me $70. On May 5th, I bought another inventory. It cost me $75. On May 6th, I bought another inventory. Yeah. It cost me $95. Now, in the FIFO system, if I want to sell, I sell what? The first that goes in. So the first in, there'll be the first that I'll sell. So I will sell the one from May 3rd. Then before I go to the one from May 5th, and then that is why you see still there. May 6th is still there to form your ending inventory. I sold what? May 5 and May 3 because they came in first. It's different for the last in, first out. The last in means the one that came in last will be the first to sell. So now on May 3rd, the same thing. I sold what? I bought an inventory and it cost $70. On May 5th, I bought an inventory and the cost is $75. On May 6th, $95. So the last in is on May 6th and the first in is on May 3rd. Okay, because May 3rd, the inventory came in before May 6th. So the last in will be the first to leave. That means I will sell the ones I brought on May 6th and sell the one I brought on May 5th before I sell the one on May 3rd. So this will be sold first before that. So we'll not worry about the weighted average cost for this class. But for this, let's keep in mind what the first in, first out means. First in, to summarize, I summarize once again. Okay. The first in, first out means the goods that you buy first, those will be the goods that you'll be selling first. Is that understood? Then the last in, first out is the goods that I buy last will be the one to leave first. As simple as that. Let's look at the example. Um, sorry. No, no. Sorry, but my PC is kind of like freezing at this moment. I don't know why it's not bringing out this document. Then, sorry. Oh. Mm. Anyway, hey, sorry, um, let me share my screen. Sorry about the disruption. Yeah, I'm gonna share my screen. Share. Yeah. So I'm back, and just want to complete the setup, then we can continue. Okay, so yeah, we can continue. Sorry about the dispensations that just came in to set in, and yeah, so at this time right now, I want us to look at the problems. I believe you can see my screen, and just to confirm, so I'll continue to share my screen so that we solve the problem. And this is M2, which talks about the calculating shrinkage in a perpetual inventory system. So let's look at the problem. ABC Stores has $4,000 of inventory on hand. And as you're looking at that, let me draw the problem to you so that you can also see. Uh, um, yeah, so that is the beginning inventory that you see in the problem. That means it had 4,000 inventory on hand at the beginning of the month. That is beginning inventory. And during the month, the company buys $41,000. That is the purchase, okay, of merchandise. So purchases is what? $41,000. Remember, we said beginning inventory plus purchase minus ending inventory is equals to cost of goods sold. Or beginning inventory plus purchase minus cost of goods sold equals to ending inventory, depending on the inventory system, whether perpetual or periodic. So the one that equals the cost of goods sold is the periodic system. But if it equals the ending inventory and then you have cost of goods sold for this side, it becomes, something like this. Beginning inventory plus purchase minus cost of goods sold will be equal to ending inventory. This is uh, uh, yeah, this is the perpetual. Why this is the periodic inventory equation. Uh-oh. Are we together? I believe we are together. So when you add the beginning inventory plus the purchase, it gives you the cost of the goods that are available for sale. That is the goods that are available for sale. How much will it cost you to sell them? It gives you that amount. And let's look at the question again. And that should be which one browser. Let me get there. Okay, so and sells merchandise that had cost $30,000. So then, sorry, I'm not having a very efficient system. Okay, so this is the cost of goods sold, $30,000, as mentioned in the equation. Therefore, your ending balance becomes the difference between the goods available for sale and then the cost of goods sold gives you your ending balance, which is this. And if we read the question further, it says at the end of the month, $13,000 of inventory is on hand. How much shrinkage occurred during the month? At the end of the month, we're having $13,000. However, the ending balance should have been $15,000. But we are having $13,000. That means something is missing. There's a shrinkage of $2,000. That means $2,000 worth of items have either been stolen or miscalculated by the cashiers or some fraud situations there. That is a shrinkage that occurred in this particular problem. And that is for M62. Let's look at M64. M64 is pretty kind of straightforward. ABC Incorporations operates department stores located primarily in blah, blah, blah. In its 2019 second quarter report, the company reported cost of goods sold. This is the cost of goods sold, this amount. Therefore, let's go back to that sheet. You'll see that, remember, this is our equation. The cost of goods sold is this. Let me take away this for now to avoid confusion. This is the cost of goods sold. The question set is 1030 million. That is 1 billion. Okay. And then ending inventory for the second quarter of 1600 million. That is 1.6 billion. And that becomes our ending inventory, EI. Okay. And then it's asking us to calculate the purchase, and it gave us the beginning inventory to be 1830. So by the time you make the substitution and solve for P, you get your P to be this minus 1830 plus 1600 to give you 800 million. If you need further understanding, meet me in the office hours. We'll talk about it. And I'm kind of like tempted if I should talk about, okay, let me just talk about it because I'm no longer comfortable with the length of the video. It's getting too long, but let me just talk about it for the interest and benefits of those who would want to understand and learn. So let me go to many exercise. 7, we were supposed to deal with 7, 6, and 7, 7, right? Okay, 7, 7, and 7, 8, rather. Let me take this away. Okay, let's go to 7, 7, and 7, 8. Calculating the cost of goods available for sale. Ending inventory, EI. Sales, cost of goods sold, and gross profit under the periodic FIFO. So we are talking about periodic inventory system, and the formula for the periodic inventory system is this. Remember, it is what? This is the periodic system. Beginning inventory plus purchase minus ending inventory is equal to the cost of goods sold. The FIFO means the goods that go in first in will be the one to sell first. So here, the beginning inventory, remember, is there before the goods you purchase. So you sell the beginning inventory first before you go to sell the purchases. I believe I'm making sense here. Well, don't worry, just have that in mind. Sell beginning inventory first and then sell purchases next. But for FIFO, for LIFO, you sell purchases first before you sell beginning inventory. That means the purchases is the last in, right? And then you sell it first out. Okay. So let's look at the question again. Given the following information, calculate the cost of goods available for sale and ending inventory, then sales, then cost of goods sold, and then the gross profit under the FIFO, assuming a periodic inventory system is used. Here, this business on 1st July, it had a beginning inventory of 50 units, let's say 50 Gatorades, 50 bottles of Gatorade on the 1st of July. And one bottle cost $10. That means the total bottle available in the Gatorade in the store becomes $500 worth. Okay. The unit cost times the unit gives you the cost of inventory, of beginning inventory. Now, on the 13th of July, this day is my father's birthday. So on my father's birthday, I went out and I purchased 250 additional bottles of Gatorade. And this time it cost me $13 per bottle. $13 per bottle for 250. That means in total I have the goods available for sale, which is this part, cost of goods available for sale. Now, first of all, the goods available for sale, they are 300 bottles of Gatorades, right? And from the 300 bottles, 50 times 10 gives me 500, and then 250 times 13, we should be about 3,250, right? And then I sold 100 bottles. Now, it's left for me to decide which system of inventory that I'll be using in my sales. But the question said we should stick to FIFO. That means the first that comes in goes out first. That means if I sold 100 bottles, I will have to sell completely the 50 bottles of beginning inventory. Then I'll sell another 50 from the one that is purchased, so that I'll be left with 200 bottles as my ending inventory. I hope you understand this concept. I repeat it once again. If I have 50 bottles beginning, and then I buy an additional 250, I have 300 bottles available for sale. Now, FIFO says I sold 100 using the FIFO system. That means the first goods that are in the store goes out first. The first goods in the store is the beginning inventory before we had the purchase that went to the store. So I will sell all the beginning inventory, which is 50 from the 300. I'll be left with what? 250. But remember I said I sold 100. That means from the 250 that is remaining, I sold another 50 from the purchase to make the remaining balance ending inventory to be 200. That is what this question is saying. But if I'm using, which is your 7.8, now the thing you should use the periodic LIFO inventory system. In the periodic LIFO, if I sell 100, that means the last that came in, which is my purchase, will be the first to go out, first out. That means I will sell 100 bottles from this 250, and then I'll be left with 150 of the purchase, and then 50 of beginning inventory, which still makes 200 in total. I repeat again. FIFO. I sell 50 beginning inventories, and then sell 50 from purchase. But LIFO, because I sell the last first, I go to the purchase and sell 100 out of the 250, and then I'm left with 150 purchase and then 50 beginning. So if I will sell again, I will go and sell the remaining 150 before I go to the beginning inventory under the LIFO. I hope this is clear. And let's go back to the question. So let's read the question quickly. It says, well, if you calculate the cost of goods available for sale, the ending inventory, the sales, the cost of goods sold, and then the gross profit under the FIFO system. Let's look at that here. Beginning inventory plus purchases, goods available for sale, minus ending inventory. The beginning inventory, we had 50 bottles of Gatorade at $10 each. We purchased 250, this time at $13 each. And when you multiply that, you have what? 500 and 3,250 respectively. What is the cost? The goods available for sale, remember I told you is the beginning inventory plus the purchase. It becomes this plus this to give you 3,750. Now, FIFO says the first in, first out. That means the beginning inventory, you sell them first. You sell 50 units of the Gatorade, and then you sell another 50 out of this 250 that cost you 130. That's why you're seeing you having what? 50 times 50. The goods sold, the ones I sell 50 of the beginning inventory at what? $10 per unit. And then I go into the remaining, which is purchased, because remember the question said we sold 100. So I go into this and then sell 50 out of this at this rate. It gives me the cost of goods sold. And if I minus that from the goods available for sale, it gives me the ending inventory. As simple as that. If you need further explanation, meet me in the office hours. The sales is very simple. Sales is nothing but the quantity sold times the unit selling price. The question tells us that the unit selling price is 15. Can you see? He sold what? 1,000 bottles, 100 bottles for $15. And let's go back. For 15. So the sales becomes 100 times 15, which is 1,500. And then the cost of goods sold is just as above this, and the gross profit is the difference between the sales and the cost of goods sold to give you 350. That's that. We're using the LIFO system. The beginning inventory remains the same at $10. Then the purchase is 250 at $13. Now goods available for sale still remains the same, which is 3,750. Our ending inventory. Now we sold what? 100. But the 100 that we sold is what? Last in. The last in is the purchases. So we sell 100 from the purchase at this rate. It gives us the cost of goods sold. And when we subtract that from the ending inventory, from the goods available for sale, it gives us the ending inventory of 2,450. And the sales remains the same. However, the difference here is that the cost of goods sold becomes 1,300 instead of 1,550. And when we subtract, we get 200 instead of 350. And this brings us to the end of the class. If you need further clarification, see me in office hours. Thank you.